The Bank of Canada has held its key interest rate for the third consecutive time.
At our meeting this week, we decided to maintain the policy rate at 2.25%. As the outlook evolves, we stand ready to respond as needed.
That's Bank of Canada Governor Tiff Macklem at his most recent news conference. The central bank's decision to hold was widely expected, but the path from here is murky.
Inflation in Canada has been close to the 2% target for more than a year now. But as we've seen, the war in Iran is causing oil prices to move sharply higher, and this will push inflation up in the near term.
As always, here to unpack the latest decision is Scotiabank's chief economist, Jean-François Perrault. He will tell Natalie Nanowski about what it means, give us an overview of the Canadian economy, now amid uncertainty and geopolitical risks, and tell us where rates may head from here. I'm Armina Lagaya, and this is Perspectives. Now, here's Natalie Nanowski.
JF, thanks so much for joining us as always.
It's a pleasure.
So we're recording this after the Bank of Canada announcement. First up, take us through Wednesday's decision.
So the Bank of Canada didn't raise interest rates. That wasn't anybody's surprise. They didn't cut either. The expectation going into the meeting was that they wouldn't do anything, and of course that's what they did. So on the surface, it's easy to say, well, that was a pretty straightforward meeting for them to navigate because they did essentially what they said they were going to do, which is nothing. But the reality is that the environment in which that decision was taken and likely future decisions will be taken is extremely dynamic. Dynamic in part because the war in Iran and its impact on oil prices and confidence in supply chains is unfolding on a daily basis. You know, it's challenging the outlook. It's challenging the inflation outlook very, very significantly. And for central bank, which targets inflation, that's a meaningful thing. But also because coming into the year, we had some weak trade data and weak labor market data, which suggests that maybe the first quarter we're starting off on a bit of a softer track than they'd anticipated. So on the one hand, a little bit weaker growth. On the other hand, probably stronger inflation, conflicting challenges for central bank, which led them at the end of the day to not move it, not do anything, which again is what they said they likely were going to do, but a lot more things for them to consider than I think they would have anticipated during their last set of deliberations.
Before we look at all of those international factors, let's look at some of the factors here at home in Canada. Paint us a picture of the economy now and why the governor believes that right now is the time to keep rates steady for the third time, basically in a row.
Yeah, I mean, as we continue to adapt to the world in which we operate, obviously, trade uncertainty has fallen a little bit with respect to how it was last year. We still are worried about CUSMA-related renegotiations, reviews, and there's some uncertainty there. But generally speaking, going into the beginning of the year, what we had seen in Canada was pretty strong job growth in the second half of last year, a pickup in the measures of household spending, a pickup in auto sales, a pickup in some of the rate-sensitive parts of the economy that suggested that we were going into 2026 with a bit of momentum. In 2026, what we've seen so far is a little bit of an unwind of that. So we've seen pretty significant job losses in the month of January, surprisingly large job losses, which offset only a part of the very strong job gains we saw in the second half of last year. We saw some pretty weak export numbers in January as well, which are a contrast to December export numbers related to some auto plant kind of retooling things. So it's not necessarily a huge concern, but it does suggest that the momentum that we thought we had going into 2026 might be a little bit weaker than we'd anticipated. That's set against a world where, we're looking at, for instance, auto sales, which remain very strong so far this year. So consumers are still making these big ticket decisions. We look at measures, say, related to business confidence, so small business confidence. The CFIB, for instance, publishes a business barometer every month. And that's seen a pretty significant increase in small business confidence into the first few months of the year. So it's a little bit of a mixed bag. But we think the economy is set for a meaningful increase in 2026, slightly more than a percentage point and a half, somewhere in that range, which is roughly what the Bank of Canada thinks. And it's not super strong, but it's not recessionary conditions either. We'll know much more as we go forward, obviously, but the idea has always been that 2026 was a year in which you'd start off a little bit weak and then build as you progress through the year, as the Prime Minister's economic transformation agenda starts to kick in a little bit, as fiscal policy in the provinces kicks in a little bit more. We've seen very big deficits announced for the next year or so for most of the provinces. As business optimism picks up a little bit, as consumer-related uncertainty fades. Now, this is in a world outside of, as you point out, the international side of things. But those are all things that suggested to us that as the year progressed, you'd get gradual momentum building, and that second half of 26 and 2027 would be substantially better than what we'd expected early in 2026.
Okay, so let's move to that international side right now. A big issue that was looming over Wednesday's announcement was the war in Iran. Take us through how the situation there and how the control over the Strait of Hormuz, the passage that ships, oil tankers need to pass through, is going to have an effect on the Canadian economy.
This is a big deal. There's no questions about it. It's a big deal in a number of dimensions. It's a big deal in part because 20% of the world's oil comes from that part of the world, and it transits through the Strait of Hormuz. So in the broader context, this war and the attacks on Iran and the Iranian retaliation against other countries has led to virtual standstill in tanker traffic through the straits. That has led to a very significant increase in global oil prices and global gas prices as well, which is particularly important for Europe, and to the point where WTI is close to $100 as we talk about this, significantly higher than where it was before. That is inflationary. For countries that import oil, it's a huge negative shock for much of Europe, for instance. For countries that export oil, like Canada, it's almost certainly a positive shock. Now, not a positive shock for everybody in the country, obviously. Folks in Ontario don't produce any oil. Folks in Quebec don't produce any oil. Same in BC, but other parts of the country do. So you have kind of a differentiated response. But historically, high oil prices are good for Canada. The challenge is this is such an uncertain environment. We don't know how the war is going to unfold. We don't know how long it's going to last. We don't know if there are going to be further disruptions. We don't know if the Iranians are going to attack even more oil fields. So there is very significant uncertainty about where oil prices go from here. How much further do they go? How long does this last? And as a result of that, you're getting some pretty significant challenges in financial markets. You're seeing equity markets come down significantly since the beginning of the year. That offsets, from a Canadian perspective, some of the strength that you get from oil prices. If the TSX is down a lot, well, that hurts Canada. Even if oil prices benefit us. You've seen interest rate expectations change significantly. You've seen borrowing costs in the 5 or 10-year space rise significantly as markets start to think that the oil price increase, as it filters through the rest of the world, is going to be inflationary and might force central banks to do things differently than otherwise would have been the case. So all those things are impacting Canada, impacting the US, impacting the rest of the world in a very significant way. We happen to be lucky in that we produce a lot of the stuff that is being impacted, and it's much more valuable now than it was a couple of weeks ago, certainly a month ago. So we have a big offset that most other countries don't have in this context. But the reality is that this is just it's an event that challenges our ability to make any macroeconomic predictions. In fact, Chairman Powell, the chairman of the Federal Reserve, when they had a decision on Wednesday as well, was asked a question about forecasting this environment. And he said, gee, basically, I wish we didn't have to make a forecast because it's so difficult given the uncertainty that there is. So it's very meaningful, but the extent to which the damage or the consequences bite are really a function of how long the interruption in oil supplies last. If we go back to normal in a couple of weeks, not such a big deal. If, as seems to be increasingly the case, as the attacks kind of rise in amplitude on a daily basis now, if that's not the case, that is to say, if the escalation continues, if the conflict lasts a month, 2, 3, 4, then you're in a world where oil prices can easily be $100 for a sustained period of time, with, unfortunately, very significantly negative impacts for the rest of the world. For Canada, a mixed bag with some regional variations that can be quite significant.
I want to unpack those regional variations just a little bit because, for instance, as you mentioned, Alberta could benefit from these oil prices. Ontario, BC, more manufacturing provinces, maybe not so much. And they're also going to be dealing with, a hike in food prices as well, because when oil prices go up, food prices go up. So can you unpack a little bit about some of the dynamics we may see happening between these regions?
Yeah, I mean, and that's the reality of having a diverse country like we do. It's fine to say commodity prices are good for the country, and they are, but not every part of the country produces commodity prices. What you're also seeing, incidentally, as a result of the conflict in the Middle East, is fertilizer prices rise significantly because urea is produced very heavily in that part of the world. That actually ends up benefiting Canada to some extent as well because we produce lots of fertilizers too, even though it's an input to some of our crop exports. So what you have is a situation where, what is clearly good for a significant part of the country poses significant challenges for others. Ontarians are going to pay more at the pump. Quebecers, the same thing. Well, actually, all Canadians will. To the extent that there is residual uncertainty with respect to CUSMA, weak manufacturing, maybe auto sales are going to be constrained by these things. If people are paying more for oil, they maybe have a little less money to spend on food if food is more expensive, or entertainment or travel, or those kinds of things. So those are kind of the normal channels through which you would expect oil prices to kind of work through an economy. But it's unquestionably the case that as we think about Canada this year and the higher oil prices are, when we do a provincial forecast, we'd raise Alberta up a little bit, probably raise Newfoundland up a little bit, maybe a couple of other provinces up a little bit, and others down a little bit because of these impacts. Now, over a period of time, if the oil patch does really well, that translates into more business activity in the rest of the country as well. There's no question about that. So that's why we know that over time, high oil prices benefit the country. It won't feel that way for all Canadians.
And Canada, I would say, has been through a lot in the last several months. We've had tariffs imposed on Canadian goods, tons of trade uncertainty. We're building new trade partnerships, and now there's the war in Iran. How much can the economy take before a policy rate change needs to happen?
I mean, it's a good question. But again, we're somewhat fortunate in Canada in that it's a little bit more clear in our context what needs to happen on the interest rate side. So because oil prices benefit us, generally speaking, it's a bit of a different ballgame, say, than for the European Central Bank, where they've got this situation where oil prices are going up, gas prices are going up. That's highly inflationary for them, but it's also really bad for growth. So this creates what we call a stagflationary shock, where growth and inflation are going in very different directions. In Canada, what we're probably going to see is inflation rise, growth probably rise a little bit with that, so kind of going in the same direction, making it slightly easier for the Bank of Canada to manage this. Now, we've thought for a long time that Bank of Canada was going to be raising interest rates in the second half of this year anyways, and this oil price shock kind of solidifies that reasoning to some extent. In fact, markets are now anticipating 50 basis points of increases as of today for the Bank of Canada in the second half of 2026 as well. You're seeing other central banks talk about this as well. There's been quite a few decisions by central banks the last few days in advanced countries where they're all struggling with the same thing. How long is inflation going to rise as a result of energy prices? And of course, to get that answer, you need to know, well, how long will energy prices rise? So it gets back to the duration issue of the conflict. But typically speaking, central banks would look through what we call a supply shock, an oil price shock. There's not much a central bank can do. If oil prices go up, raising by 25 basis points to 50 basis points doesn't really, make oil prices go down. It allows you to manage that shock a little bit. So what the Bank of Canada has indicated they were going to do in their decision on Wednesday was to ensure that as oil prices rise, that it doesn't lead to a broader inflation. And that's really the concern central banks have in these environments is, have this oil price shock. You don't want people to start thinking inflation is going to keep rising, so I should expect to pay more for food, more for cars, and more for for clothes, for all kinds of things that are unrelated to oil prices to some extent. So it's called expectations management. They want to make sure that people don't believe that inflation is going to keep rising if it's rising because of oil prices. So the government made it very clear that they expect inflation to go up a little bit in the short run because of oil prices. But if they see any evidence that increase in oil prices is leading to broader set of price increases, then they'll come in and do something about that. And that, of course, is something that we saw in the pandemic. It's something we've seen in the past before, that you've got to be really mindful of how inflation expectations evolve, how people think about inflation as you set monetary policy. Because once people start to think inflation is going to rise and it starts to rise, it becomes much more difficult for a central bank to try and bring that down, which was the experience post-pandemic. So the governor has indicated they'll be very vigilant. Even though growth is a little bit softer than they thought, they're very mindful of the inflationary consequences of this oil price shock, as are other central banks. And you're likely to see as a result of this, higher borrowing costs at the short end as central banks adjust interest rates in response to what is going on in oil markets because of the war in Iran.
So in January, when we spoke, Scotiabank was forecasting a rate increase in the second half of 2026. Is that still something that you think is going to happen?
Well, we are much more confident about that now than we were back then. And in fact, the markets are now pricing in the same amount of rate increases. So that's comforting to some extent. Now, the circumstances for that call are a little bit different now than they were in January. We certainly did not anticipate a war with Iran. But this war and this dynamic of higher oil prices, probably a little bit stronger growth as a result of that, and of course concerns about inflationary expectations, seem to solidify the case for a rate increase in the second half of the year, if not before, depending on if oil prices rise even further from where they are now, if the conflict gets even worse.
This is all happening while there's the most mortgage renewals in Canada happening this year. I know I got a call from many friends asking me if I'm going variable or fixed. How are people supposed to weigh all of this information and make a decision?
I mean, it's never an easy decision for a family to decide on. Do they go a fixed rate, longer, fixed rate, variable rate, short, long mortgages? It's always a challenging situation. So it should be a difficult decision to make. We've thought for a long time, and we've been advising folks for a long time, including on our last call, that we thought going forward in 2026 that the odds were greater that borrowing costs would rise than they would fall, and that you're better off logging into a mortgage sooner rather than later, for fear that the longer you wait, the more expensive that mortgage is going to be. And we seem to be evolving into that world where some of those risks around possibly higher rates seem to be materializing. So I would encourage folks to, if you are thinking about renewing your mortgage, that there is an advantage to going sooner rather than later, to locking in sooner rather than later, as a result of this tremendous amount of uncertainty going on, which ultimately are going to impact inflation, which have the real potential to impact borrowing costs, both short term and longer term.
What we're also seeing here at home is basically home prices falling. How do we factor that into the mix as well?
Yeah, I mean, the real estate market's been a little bit soft. There's no question about that. Some parts of the country better than others, of course. Falling home prices are a result of a slowdown in economic activity. It's not much of a surprise, and of course uncertainty associated with that. Home prices are lower than they were in 2022 at the peak of home prices. We expect that's pretty temporary. We think that as the year progresses, we get a reversal, and as the supply-demand imbalances, which remain very large in Canada, in favor of suppliers, that is to say there are more people needing homes than there are homes available, that's going to put gradual upward pressure on prices. So again, if folks are thinking about a purchasing decision and hoping that maybe house prices are going to come down in the next several months, and that maybe 3 months from now will be a better time to buy a house than now, that's possible. But there is a risk that as the further one waits, the more that supply-demand balance starts to be reflected in prices, the more the adjustment is in the rear window as opposed to the windshield, the front windshield. There's a potential for house prices to start accelerating, say sometime in the summer. So again, it's a word of caution. There is a risk that the more you wait, if you are thinking about buying a house, again, this depends a little bit where you are in the country, but not so much, that you may in fact wait a little bit too long. And not only would you have maybe a more expensive home than you would have now, but also the cost of financing that house might be more than if you were to purchase something sooner rather than later.
Okay, we covered a lot on this conversation. What is the main takeaway that you think Canadians should have from all of this?
Well, I think it's important to keep some degree of optimism around. Like, we know that oil prices are rising, and we know that for a lot of Canadians, this is an issue. We also know that for Canada, higher oil prices are generally good. So that's an important thing to keep in mind. It's not because oil prices are going to go up that we're going to have a recession in Canada. That's not happened before, probably not going to happen this time around. So I would keep that as a bit of a bright spot, if you will, given this extremely gloomy situation in the Middle East. I'd also point out that there is uncertainty with respect to President Trump's actions and what it means for us, and review of CUSMA, and there's some uncertainty there. We've long thought that the risks around a review of CUSMA are overblown, that the president has kind of indicated that he's more or less comfortable with most of the deal, and that we expect, in our base case, that not much changes as a result of what's going on between Canada and Mexico and the US in terms of reviews over the next few weeks. So don't count on that uncertainty accelerating. On the contrary, you probably think that as the year progresses, there's less uncertainty there. So more reasons to be optimistic as we go forward than we have seen. That being said, there's no question that there are risks around. There's no question that the duration and the intensity of the conflict there can escalate very significantly. It could cause lots of financial market turmoil. It could cause equity markets to go down significantly more. It could cause confidence to fall significantly globally and domestically, and that is a real challenge to manage. That, unfortunately, is outside of everybody's hands, except for a few, very important people in the world who, are able to control military forces. And then finally, I just remind folks that, there is probably going to be rate increases by the Bank of Canada in the second half of this year. It's not something that, we're thrilled about. It's something that we think is probably going to happen, but, recent events suggest that that's even more likely. So, keep in mind as you make a financial decision that it is likely to be the case that 6 or 7 or 8 months from now, borrowing costs are going to be higher than they are now, and that one should act in consequence with that.
All right, JF, thanks so much. We'll leave it there. Thanks for joining us.
Well, thanks very much. It's always a pleasure to chat.
I've been speaking with Jean-François Perrault, Chief Economist at Scotiabank.
The Perspectives podcast is made by me, Armina Lagaya, as well as Ned Kelly and Natalie Nanowski. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.